So thanks all for those who have joined on this exciting topic about the AI ML, AI and ML advancement in front office pricing and valuation. And as IIQF, maybe we brainstorm on a lot of adoption topics and specifically AI and ML in various areas. And we think that this is an opportune time that AI and ML is getting traction in derivative pricing and valuation, and in general the front office pricing and valuation problem sets. So that's why we thought that maybe this would be the right topic to capture the dynamics there, and what kind of trend and future outlook would uh, be there for AI and ML adoption, and how it would help in solving some of the very complex and intricate problems within the derivative pricing and valuation. So first thing first, the area of derivative pricing and valuation has been very much uh, you know uh, uh, challenging and daunting area, with a lot of different challenges which have been somehow managed so far with traditional models. And by traditional models, I'm talking about the analytical formula based Black-Scholes Merton formulation based model, which is an analytical closed form approximation of any option pricing. But that is as far as maybe its application is concerned, that is very confined to very simple plain vanilla standard derivatives like European call or European put option. uh, and then maybe a lot of the complex derivatives are being modeled through Monte Carlo simulation and stochastic differential equations, right? So the pricing of complex intricate derivatives have been an area which has been left to the numerical techniques. um, because analytically we could not apply Black-Scholes model there, given that Black-Scholes make very simplified assumptions about the market dynamics and asset pricing behavior. So we got to use some alternative, and all these last 2 decades, right, more than 2 decades since the derivative market has seen a humongous growth. The most of the high street banks and broker dealer firms and different complex funds like hedge fund and other or quant trading firms, they have been using Monte Carlo simulation as the main power horse, right? So that is the case for even any kind of derivative pricing, right? But the problem still remains that the derivative pricing, and especially in today's high frequency trading area, and with a lot of complex derivatives like basket products and structured products being coming out, uh, the the problem and the challenges still remains abound. So I'm going to cover on this slide those most prominent challenges and daunting tasks when somebody is into the front office pricing and valuation on a derivative desk or a structured product desk. What kind of difficult issues and you know modeling quants challenges one would face. The first one is very clear, and we know it by high dimensionality, that most of these complex products, structured products and derivatives, they are as a from the data side, they are very high dimensional problem. What we mean by that, we need to estimate, the model is required to estimate a very large huge number of parameters. The feature space is very huge, right? So is the parameters which the model need to estimate, but the data set is somehow limited. And especially when it comes to the OTC, over the counter derivative products, which are very sparsely traded and doesn't have that much liquidity in the market. And those kind of bilateral OTC products, you could see that maybe there are not many the pricing data is not that huge, as much to leverage for estimation of these large number of parameters. So then hence we could say that generally when it comes to complex pricing problems, the we always end up facing the bottleneck of high dimensionality, right? So that's the first one. The second one is that most of the complex products generally have nonlinear payoffs, and you need some flexible function, right, mathematical function to estimate to estimate such non-linear relationship among by solving some non-linear system of equations, right? And many a times, numerical techniques like finite difference schemes or Monte Carlo methods or Markov chain Monte Carlo methods are applied, right? And But they are inefficient because uh, as the complexity of the problem and the non-linearity of the problem grows larger, the training time required by these traditional techniques would go maybe several bounds up, right? So would go grow multiple folds, right? So that's a problem. Although maybe Monte Carlo is very good at solutionizing a non-linear system of equations, or maybe solving for it, right? uh, but the problem is that the kind of iteration or the kind of time, runtime or training time it takes, it's and the kind of computational resource requirement, like the GPU it consumes or the computational power it requires, it is a massive burdensome on a bank in terms of costs involved, in terms of maybe budgeting involved, right? The third thing, which is most prominent problem which one could face in front of his pricing and valuation, is optimality, right? So optimality means that generally optimality means different thing to different people, right? But in general, if you encapsulate the optimality in a broader sense and paraphrase it, what it really means is that you need to mimic the behavior of a rational optimal investor who would exercise a particular derivative or option, right? Specifically those complex derivative where there are you know um, several embedded optionality, right, for them to exercise at different points, for them to maybe exercise based on different barriers or thresholds, right? So based on these different multiple conditions within the derivative instrument, right, what are the conditions for the open choices for the rational investor, for an rational investor or optimal investor to optimally exercise the option. Now the task become even harder when such derivative instruments or products are designed very in a very complicated or intricate fashion, with a lot of uh, you know uh, uh, optionality given to the investor to exercise the option at multiple points and based on maybe multiple triggers, right? The more the trigger, the more the points at which the investor could exercise the option at hand, the more is hard uh, to solve the problem, right? And some of these problems are hard to solve because then you have to do multiple Monte Carlo simulation, multiple paths, depending upon whether one trigger happen or another trigger happen, it happen at one point in time, it happen at multiple point in time. What is the most optimal time when the a rational investor or an optimal investor would exercise the option? So that become a challenging task to train the model on, right? The next daunting task in front of us while dealing with the pricing and valuation problems is time dependency. Now, it's not the case for some of the very simple plain vanilla standard derivatives like European call and put, right? Because they are only exercisable at maturity. But it's more so the case with those which are time dependent option, right? Maybe uh, Asian options, right? You Bermudan options, American options, right? So the throughout the lifespan of the option, you could exercise the option at multiple point in time or at any time, right? And then the model need to extensively cover all the multiple option exercise points, as well as the revaluation of those particular derivative would happen on a frequent basis, like daily revaluation for the PNL, right? So you got to revalue the derivative MTM. Revaluation means in terms of fair value, we need to calculate the mark to market value or mark to model value, right, of that particular derivative on a frequent basis. And that would in itself becomes very challenging, because then the model need to have this capability to revalue the derivative, right, at multiple point in time, rather than at a limited set of points, which could be the case in under a standard derivatives, right? The next thing is also related, like part dependency, right? So part dependency means that if an option, especially the Asian options, they are part dependent, right? Some of the exercising condition of the Asian option says that, like you take the average of the price, right, till that particular point, and compare it with the strike, right? Something like how the price path has evolved till till a particular point, that average price is compared with the strike to assess whether the option has a positive MTM. It means that the investor or the buyer of the option or the derivative could exercise and have some profit out of it, or it doesn't have any, it is out of money. Whether it is its moneyness, degree of moneyness, or in the moneyness or out of the moneyness, is indeed dependent upon the path it has taken to evolve, right, till a particular revaluation point. And then you require exhaustive simulation. The model need to have some mechanism of building exhaustive simulation of all those evolutionary paths, considering all underlying market events, right? And last but not the least, for a variety of other use cases, so all these use cases which I pointed out are relevant to different areas, but more so to front office pricing and valuation. But consider yourself, you are not only pricing or doing this pricing or valuation exercise only for front office, right? uh, this pricing and valuation exercise is also done for the Basel capital estimation, for also for hedging the risk, right, of the portfolio, also for maybe doing some risk management, like deciding based on some expected shortfall or VAR measure, deciding what would be the appetite or limit which you should be setting on a particular counterparty with which you are trading this derivative, right? So a lot of uh, as well as deciding under a maybe stress scenario what could be your maximum potential loss or peak potential loss on such derivative, right? So a lot of market scenario need to, so the whatever solution you design or device, it need to have some form of component which would capture the effect of market dynamics and market scenarios and systematic risk, right? So you need to capture the asset price dynamics under prolonged market crisis. You need to capture the market arbitrage effects. You need to capture the market liquidity effects. You need to capture the market leverage effects. You need to capture wrong way risk. So all these multifaceted challenges and daunting task at hand, right, will make the derivative pricing and valuation, and especially for front office pricing and valuation, a bit of a task which is which could not be just left to an analytical approach. Obviously it could not be solved using Black-Scholes Merton model, right? Black-Scholes pricing formula, and even numerically using some of the Monte Carlo or simulation based techniques, right? You If you try to embed all these components into your model, the model will, training time and run time will go uh, multifold, and that would be challenging, because in today's era of high frequency trading, uh, a derivative trader needs real time pricing, needs real time valuation, needs real time, dealing in market where they are able to bid and submit the bid, or submit the ask quotes, which means that the market making activities, many investment banks perform the market making activities, and they are required to submit the quotes and bids, right, in the market to to maybe to bring in some liquidity. And many broker dealer firms deal with these high street investment bankers who are called market makers. And hence, for such market making activity, as well as such high street banks, whose main feature of their investment banking side is market making activities, it requires some kind of model which is wholesome, which is completely holistic, which cover uh, almost all of these aspects, within the same model, and then be able to efficiently do the pricing, right, in a real time way, so that maybe it would not then result in any delays or latency while doing the derivative pricing business, right, conducting the derivative pricing activity or market making activities. So that's one, right. So that's where maybe these are. And coming from the first slide, we talk about the challenges, and now we should also talk about the brighter spots, right. What are those brighter spots which are illuminating this area of derivative pricing and valuation, right. So the uh, adoption of AI and machine learning, which is a tectonic shift from the erstwhile or current way of doing modeling, which is based on either analytical approach or some maybe simulation based, Monte Carlo simulation based approach, right, to an advanced machine learning models like deep neural network, right, is a tectonic shift. It is a transformational and disruptive change, because it at least addresses those multi-year or even decade long problems of which the derivative trader and quants are facing around the efficiency gains, the computational cost, the time constraints, the need for real time analytics, the need for considering some of the alternative data set like modern day data set. All these things together, if you put, are somehow reasonably addressed by adoption of machine learning, especially advanced machine learning techniques which are called deep learning, and within that what we call neural network, deep neural network, right. So we could maybe consider this as a business case and see what are the promising bright spots offered by this particular business case of moving the quantitative discipline or the quantitative modeling discipline within front office pricing, uh, you know f- uh, uh, from a typical conventional modeling to new data driven way of doing modeling, right. So uh, I'll call out those particular things and what are the main advantages or merits of adopting AI and ML in derivative pricing and valuation area. The first thing is that it allows you to build a exhaustive simulation engine for all financial time series, uh, which allows you to simulate paths for statistical computation and learning. Now you would say that, okay, wasn't it the case for Monte Carlo simulation? Yes, it was also the case for Monte Carlo simulation, but the new thing which the machine learning, AI and ML machine learning brought is that you could achieve multi-asset pricing by using the same simulation engine. It means that some of the uh, you know uh, the underlying risk evaluation factors, right, right, which used to drive the Monte Carlo simulation could be calibrated within the same model, and then that those could drive the price across the pricing solution for multi assets multiple assets or multiple different kind of instruments type, or different kind of asset type, right, within a broader maybe segment, right? So this particular simulation engine capability for modeling multiple time series and to simulate paths and to note interdependencies is a great advantage which is brought by maybe AI and ML. And this AI and ML also bring efficiency and computing speed to it. So that's also that the AI and ML techniques and whatever deep learning techniques and how we train them are turbocharged when it comes to performance. They could use parallel computing, they could use thread computing, they could use distributed computing to train different components which were highlighted on the previous slide in parallel run, so that the model runtime would be reduced drastically. And that's the key, right? A simulation engine doesn't mean that it's some kind of a batch, or it's some kind of a long run procedure or a model which keep running for days, right? It means that a simulation engine means that it should have the capability to produce prices in real time, to do valuation in real time. So that's the power horse maybe, or you know horsepower of maybe using AI and ML there. The second aspect is the ability to uncover and replicate empirically observed statistics about asset return time series. Now, under the traditional or conventional model, you were quite aware that a general maybe theoretical framework was adopted, where a set of assumption was first made about the market dynamics, or the asset price dynamics, or the asset return dynamics. The markets are complete, the markets are perfect, the markets are arbitrage free, the markets many of the variables hold a linear relationship, right? There's no transaction costs involved in dealing in the market. There are no entry exit barriers. All those different set of assumption which constitute a model could be completely relaxed while when you are building a ML based or deep learning based neural network model, right? You could completely relax those assumptions, and any which way, under the current volatile markets and the current times, very volatile times we are living in, right? Any which way, those assumptions doesn't hold good for long, right? So you need some kind of a dynamic pricing solution which could completely relax those assumptions, relax some kind of theoretical hypothesis about the market, that this is how the market would operate, and this is the ideal way the market should operate, right? You if you you and your pricing could be affected malign by that thing, because you priced a particular derivative under the perfect market condition, or for the ideal market scenarios, right? But the ability to uncover those particular patterns which are actually observed in the market, you never considered, right? Because your model was very assumptive, theoretical, or built upon a hypothesis, right? Now, if you relax those completely, and you build a model purely based on a data driven way of modeling rather than a theory based models, you build a data driven way of machine learning way of building a model, then you could completely relax those, and you could incorporate some of the factual things in the market. Like, what are those factual things in the market? That linear autocorrelations are often insignificant, statistically insignificant, right? So though there are some linear autocorrelation, which means that the variable or the price is dependent upon the time, right? Right. But that relationship of price variable with time is statistically not that significant, right? Especially under very volatile markets. If the market volatility would be very perturbed or exacerbated, the it doesn't really matter what kind of historical price behavior the that particular price is following, right? It would completely breach the historical bounds and maybe completely start behaving in a different way, right? So the next thing is unconditional distribution. displays power law or a Pareto like tail. Now this is also very important that under the uh, you know uh, our traditional or conventional model, we are very conveniently making an assumption time and again that the stock prices or maybe the asset class prices are log normally distributed, right? Log normally distributed means that details are not that heavy, not that long, not that thick, right? Not that maybe stretched out, and most of the price behavior lies within the center of the distribution, around the middle of the distribution. But if you follow the market dynamics and collect the price data, specifically when the market exhibited very high level of volatility, you will get to know that the tails are fat, right? So should we consider for something like tail modeling, that what is happening in tail, because that's where the real fun lies, that's where the real profits and losses lies. Yes. So unconditional distribution displays a power law or Pareto like tails, heavy tails, which should be considered. This is an observed fact, right? Which if you design your model so which is purely based on data, right, a data driven way of doing building or designing machine learning models, then you will eventually naturally capture this, right? The next is the volatility clustering. The market exhibits the volatility, the price volatility, and the price volatility tend to cluster, right? That very low volatile during a very low volatile regime, low volatility on a one day is supposed to be preceded and succeeded by low volatility. So there would be periods of low volatility regime where there are multiple days or weeks of low volatility. So the low volatility trend clusters. Similarly, once a single once a singular event of high volatility comes into the market, right, it again clusters, right? Some of the preceding and the succeeding periods, sessions would be exhibiting high volatility, right? So see, volatility displays a positive autocorrelation over several days. It means that if the low volatility will happen, there would be strong chance of further low volatility in next few coming days or few coming sessions. If the high volatility will happen, again a positive autocorrelation, there would be high chances of likelihood of seeing a high volatility over the coming sessions, trading sessions, right? So that also need to be captured, right? Uh, and the autocorrelation function or the autocorrelation plot, right? When it comes to, if you plot the absolute returns, it decays slowly as a function of time lag. So as you go back in time, as you increase, your historical observation time, right? As you go back in time and you see the prices, that it shows that those prices play less and less role in predicting the future. That's also the case. But in time series, you know that in time series modeling, we generally maybe rely too much on the ACF autocorrelation function and also the past prices to predict the future, right? But sometimes if the past prices are not indicator of what is going to happen in the future, right? And especially, the ACF decays very sharply, right? Sorry, rather maybe it decays very slowly as a function of time lag, right? So maybe you could see that generally maybe collecting, basing the future price on very very yesterday price would not make sense. The next thing is the leverage effect. The market volatility, or the stock price volatility are negatively correlated with returns, that everyone will know already, that maybe volatility is also a characteristics or effect of side effect of high leverage, right? If you have taken a highly leverage trade, right, then you might see high volatility, and that's negatively correlated with return, and that's also one of the pattern or interdependency one need to capture, capturing the effect of leverage on returns, right? Then non-linear interactions between price and volume relationship, that's very important, that generally the price and volume are not linearly related but rather non-linearly related, right? Ho- so we need to capture what volumes are being traded in the market, and how the market liquidity, right, or the volumes, traded volumes, have a bearing on the price, right? And that particular relationship is not linear, right? So that non-linearity also need to be captured in the model. Now when it comes to maybe some of the uh, focus areas, maybe for maybe derivative pricing, right? uh, you could see that there are multiple applications of derivative pricing and valuation, right? In front office, the front office traders use or especially the derivative desk use price indicators, and which are produced or generated by these trading algorithms or pricing algorithms or maybe valuation algorithms. What are the price indicators, and based on those price indicators they devise their trading strategy. And especially this is more so important when you are at a working at a fund which is which is executing or designing very complex trading market trading strategies like hedge funds, right? Like hedge funds or quantitative uh, you know strategy firms, right? They do macros, they do macro based macro trend based strategies, they do event driven strategies, they do statistical arbitrage based strategies, they do anomaly based strategies, right? So what how do they design those particular strategies for them to beat the market? They need price indicators, they need good pricing models which could give them strong indicators that what are the indicators in the market, right? Based on that they design their pricing, they design their trading strategy, right? So that's one. And this particular area, as you may see, there are three focal points, and rather three uh, you know priorities, which amongst which one or two would take highest maybe focus, right? So there, one is the performance, that the model should be efficient enough, would be able to perform quickly. The runtime would be low, the execution time, the execution speed would be high, right? The model performance means efficiency, whether the model is able to produce real time pricing solutions or real time pricing or real time analytics or real time pricing indicators, right? So if a model could produce real time analytics, real time pricing indicators, real time prices, real time term structures, all of that, the model performance would be seen high. And for front office pricing, we need very high performant model, very high performant model. That's the focus. So if you are building a model for front office, they would definitely place more demand uh, on the performance. But when it comes to precision and explainability, what do you mean by precision? That the model should be, as accurate as possible, right? And explainability, that the model should be, the model should be able to explain how a particular price is arrived at fully, right? What are the parameters, and why those what those parameters capture in terms of the relationship, right, between different variables in the model, right? And how then that leads to a particular pricing outcome, right? So that kind of explainability is less of a focus, because front office generally uh, you know uh, they place moderate demands on precision and explainability, because of the simple reason that neither they have time, nor they are required to, or nor they expect even to have their models to be completely precise and completely accurate or completely intuitive or explainable, right? Or interpretable or comprehensible, right? But when it comes to some of the regulatory requirements, right, The focus regulatory reporting and financial reporting requirements. Regulatory requirements means where you are doing derivative pricing and valuation pricing for your uh, RWA calculation, risk weighted asset calculation, or capital calculation. Then the focus on precision and explainability is more, and the focus on performance is less, because you are sitting in a back office where you are doing these regulatory capital calculation, and it doesn't really matter if even if the model would take maybe few days to run, right, to complete its calculation, right, but the higher focus is being placed on whether the model is going to give me an accurate precise result, as well as once I get the results, whether I would be able to explain that particular results to the regulator, right, or to any stakeholders like internal model validators, right, internal price verification teams, right, price validation teams, right. Whether I would be able to explain the model output to someone, right, who is asking for what drives this price, right, why this price, right, why this blip in price, why this spike in price, right, can I do that move and variance analysis, can I do commentaries based on the model, is the model transparent, explainable, interpretable, comprehensible for somebody to understand. So that is the main focus in these two areas, regulatory reporting and financial reporting. So the difference being that regulatory reporting is a world of Basel compliance, Basel standards, where we do the calculation of derivative, where we solve the derivative pricing problems for doing the RWA, risk-weighted asset calculation, which form the basis of tier one capital, right, or maybe the minimum capital requirements. The financial reporting is an area where you do it for accounting standards, right, like IASB, International Accounting Standard Board, or FASB, Financial Accounting Standard Board, be it for European IASB or for US FASB, right, you need to do the fairly value the derivative, and again the focus would be on precision and explainability. But when it comes to internal risk management, like setting up a limit at the derivative desk at a product level for a particular counterparty, for a particular trade, right, for a particular asset class, you need a balancing act between all the three, right. You need not to have high expectation or demand placed on performance, precision, explainability, but rather you need a balancing act between the three. So that's quite the area. uh, and in this particular context, right, what we could say here is that when it comes to performance, we need high performance and accelerated computing performance for real time analytics. And generally the derivative pricing and valuation, as we maybe concluded from the first slide, is very burdensome, computationally burdensome, because there's a lot of complex non-linearity, time dependency and part dependency, right. And some of the techniques which are currently being used, like Monte Carlo simulation or stochastic partial differential PDEs, partial differential equations, right, are very time consuming methods, right. So here the deep learning based neural networks bring a drastic advantage and a cutting edge, which bring fast, efficient, and a solution which offer very high throughput means you could update the data, input data in real time, you could throw it to the machine, and machine will quickly process that particular throughput through a neural network, and give you the output in real time, right. So you could refresh the data, unlike in the Monte Carlo or some of the existing models, how you have a batch process, and you cannot in real time bring in some new data, right. There's some data cutoff, right, by when the data should be updated, should be uploaded to the model, right. And uh, then the model will run and take some time and produce the output, right. But the in deep learning, these are high throughput model. You could bring in inputs in the real time, especially in the context of high frequency trading, and the model could is capable of handling them in a faster, efficient, quicker way, right? Precision derivative pricing, as we concluded, require high precision, especially for the balance sheet or the financial reporting, where we do the valuation of those particular derivatives, as well as the regulatory reporting, where we do the capital estimation based on the RWA, right? Risk weighted assets, we calculate the counterparty credit risk of those particular derivatives, right? Some of the linear models, right, like delta normal or regression models, they are not very precise, right? They are not very precise, hence they have very limited use in derivative valuation and pricing, right? However, maybe artificial neural network, on the other hand, can has this capability, inherent capability, to approximate any arbitrary function to any arbitrary level of precision. You give any function, the ANN, artificial neural network, could learn that particular function, and it is called the universal approximator, right, model, which is based on some mathematics called universal approximation theorem. It could approximate, any function, right? So it means that it is quite flexible model. It could approximate, not only it could approximate any function, this gives us capability and a further headroom to to try to uh, use ANNs for very customized OTC derivatives, which are completely non-standard and very bilateral derivatives. We could use ANNs for them, right? Because no matter whatever the payoff function of that particular derivative is, the uh, ANN could approximate it quite reasonably with a certain degree of precision. Not only it could approximate any function, it would approximate a particular function, any particular function, to a arbitrary level of precision. What does that mean? That you could increase the precision or accuracy of the function estimation under the ANN, right? To any arbitrary desired level. Like, I want this particular model to be that precise or that accurate, hence its function should be very correct. It should be very correctly specified, and you could then maybe use ANN to not only to build the functional approximation for that particular function at hand, but also increase its precision to the desired level of accuracy, right? Okay. Explainability. Now, the only challenge with the for the adoption of AI and ML models for derivative pricing and valuation is being that they are called still black box. ANNs, DNNs, artificial neural network, deep neural network, recurrent neural network, the specific architectures of recurrent neural network, like long short-term memory, or maybe the gated recurrent unit, or maybe some of the deep belief networks, they are com- to an extent now, as of the current time, they are considered completely black box, difficult to interpret, their output difficult, not very good at traceable analytical traceability. Like, if you get the output, right, what Basel says is that your output should be analytically traceable. If you get the output, the somebody should be able to trace back what went into the model, how the model uh, you know estimated uh, you know um, uh, that particular output based on the input, and what kind of functions were applied, what kind of parameters were used. But that kind of transparency, that kind of maybe interpretability, that kind of attribution of the drivers, what led to this price. This price looks very correct. This price is very efficiently produced, and produced at very less time. This price, for producing this price, the ANN took very less computational power. All thumbs up. But now tell me one thing: can I explain this particular price? Can I indeed interpret this particular price, right? That's the problem. So that is an area of research here, right? So many AI and ML researchers are focusing on a game theory based way of explaining the model output, which is called you know Shapley values and Shapley explanation. And this is subject to a lot of research nowadays because it is an impediment to the wider adoption of AI and ML, and specifically uh, the complex deep learning algorithms, deep learning neural network based algorithms. So it is a quite a focus area for researchers, academicians, and practitioners alike to focus on explainable AI. So that is what we know in the market as a topic of explainable AI. How to explain the output of an uh, you know AI or ML model, right? Uh, to somebody who place very higher demands on explainability, right? Interpretability, comprehensibility, intuitiveness, right? Or transparency of the model, right? So that's an uh, thing which we are going, but maybe you could see that maybe in terms of the market outlook, uh, generally maybe the derivative trading market and the specifically the uh, fintech driven AI and ML, right, disrupted market is anticipated to grow from 13 billion in 2024 to 40 billion in 2030. It means that whatever challenges I called out, whatever solutions and brighter spots and promising outlook I showed you, that is not on whiteboard anymore, right? If such huge investment from 13 billion to almost more than threefold increase, right, within next 6 years is going to be made in the area of derivative pricing and valuation for adoption of AI and ML solution or models to do such tasks, then it's humongous, right? The market is moving in that direction. They have already committed funds. They have already started building capabilities, investing in tech, tech stack or infrastructure, or maybe examining different use cases, maybe doing all those kind of things, even bringing up some of the uh, you know um, those particular lobbying with the regulators that AI and ML model adoption should be seen positively by the regulators, right? So all of that ecosystem is already being worked out, and it's the case that uh, few models once approved by the regulator, and once regulatory trust and confidence is attained, then I think thereafter you won't see this as a bottleneck or an impediment to the progress or advancement further, right? So AI and ML uh, you know give a capability to do adaptive, dynamic, efficient, precise algorithm for path time dependent pricing, right? Dynamic and efficient, sorry, maybe this text is, I suppose, let me maybe, yeah, dynamic and effective portfolio hedging. So not only for pricing problems, but also for dynamic and effective hedging, portfolio hedging. And it would be very beneficial for arbitrage funds, quant fund, hedge funds, the hedge fund global family offices, some of the special purpose vehicle, private special investment special purpose vehicles, proprietary trading firms, high frequency traders, high street broker dealer firms, and some of the big boutique investment banks. Those are heavily invested in this particular thing. And besides this, one of the another brighter spot on profitability is that AI and ML also brings in this capability to include alternative data set and to augment your traditional numerical data with alternative data. Alternative data means that maybe non-numerical data like image data, some of the sentiment data which you could bring from the social networking sites, right? Some of the signal data which you could bring from geo satellites, like if you want to embed the impact of climate and sustainability risk on derivatives, on specific derivatives like commodity derivatives and agro-based commodity derivatives. You could bring maybe the satellite signals and maybe process them, and maybe based on those particular vulnerabilities for in the wake of climate risk, you could build another indicator how climate risk would impact the pricing of the commodity derivatives, right? Okay, right. Similarly, images, right? You could use images as well from satellites to capture different maybe dynamics of the pricing behavior, right? Especially in the area of where now there's a lot of buzz about green bonds and green bond trading or carbon trading, right? Now, carbon trading area, how you would price carbon trading, or maybe rather a derivative with the underlying as carbon trading, you would definitely need image data, you would definitely need signal data in order to build sentiment indicators into your model trading signal, which are based on the market sentiment. You need textual data, or you need Twitter data, or you need social networking data, how different analysts expresses their opinions about the market, whether they are pessimistic, optimistic, or neutral at a particular point, because the market are not always rationally driven, right? They are sometimes irrationally driven and show irrational exuberance. How to capture that particular aspect? So a lot of this particular thing, whole thing, also adds a feather to AI ML data driven hat, right? That okay, uh, the alternative data set, right, which is non-numerical is in nature, which is image data, which is satellite images, pictures, videos, maybe IoT data, right? Signals, right? Your textual data, your maybe Twitter data, right? All of this uh, alternative data set, gold mine of alternative data set, whosoever is going to get their hands on this gold mine, that would be a unique competitive advantage for any of these players. Like maybe if a hedge fund or arbitrage fund is going to get their hands on this, they would have a definite trading advantage. So with all this, the adoption of AI and ML and the advancement of AI and ML in front office pricing and valuation is not just a whiteboard thing. It's not just a business case paper, or it's not just a business outlook. It's reality, and the sooner we wake up to this particular reality and the promise that the hard to solve very hard to solve derivative pricing and valuation problems are being looked at and solved efficiently, solved more precisely, solved in a very dynamic way and effective way by the AI and ML is no less a fiat. And with that fiat, we would expect the AI and ML to completely disrupt the market and change the quantitative discipline of front office pricing. Yeah, so I would maybe take a pause here and just maybe uh, maybe give back to just you know uh, so that maybe we could start taking up some of your questions, and also maybe understand from you what are your views, comments, as well as maybe have some interactive discussions around the topic. Nitish, over to you. If you
Yes,
may.
thanks so much, Sanjay. I mean, so definitely we would take up all the questions, and maybe just before that, very quickly, I mean, since like most of the people here have joined this webinar actually to understand about the field, so very quickly, maybe I'll run you through. I mean, what we have been doing at IIQF, how you can utilize our resources to actually like again. Maybe if you're interested to make a career in this field. So just allow me like 2-3 minutes. I'll just briefly introduce our work, and then we'll go into the Q&A session, right? So as you all know, I mean, I represent Indian Institute of Quantitative Finance, a body dedicated to education and training in the field of quantitative finance, financial engineering, risk management, quantitative algorithmic trading, and AI and ML applications in finance. And we have been tirelessly working to promote this field in India for like more than 1.5 decades. We are formed by pioneers in India from the quant risk management and AI ML field, right? So, I mean, for people who are interested, like again, in deep diving into this field and like again going deeper, I mean, either you are a student or if you are already working, you want to actually transition your career, or you want to you want to go deeper in your career in these fields of like heavy financial analytics. I mean, then we do have our live instructor-led weekend programs. There are different programs which you can choose depending on your interest and inclination. Of course, again, I mean, we would be happy to guide you what kind of course one can do to. I mean, this is your background. We can guide you on those as well, right? So, I mean, in terms of courses, these are the courses that actually you can look at. So, if you are looking to make a career in the field of quant, then the course that you can look at is the certificate program in financial engineering, 7 months, very comprehensive program covering building your mathematical background and then actually teaching you all the applications of mathematical modeling for derivative valuation, pricing, risk management, essentially preparing you for the quant roles. If you're someone who wants to learn go into quants, but maybe you don't want to go too heavy in mathematics, maybe you want to only understand like the practical modeling side and maybe focus more on the risk management side, then there's another course for you. It's called quantitative finance and risk management. It's 6 months, again, weekend part-time. If somebody wants to focus more on the quant trading and algorithmic trading side, then there's a course called postgraduate program in algorithmic trading, which teaches all aspects of algo-based trading using different kinds of strategies, both quant and non-quant strategies, giving you a whole idea about the entire process on how to build and trade using an algo trading system, right? So now if somebody is specifically looking to make a career in the field of machine learning and data science in finance, so there are courses specifically designed for that. We have a course called AI for Finance. We call this the umbrella course in data science and machine learning in finance. It's very comprehensive. Over a period of around 9.5 months, we would be covering all aspects of data science for finance, machine learning for finance, and I mean, there are specialization modules as well, which you can select as electives, right? I'll go into the specialization module a little later, but this is a course which you can utilize to prepare yourself and make a career in the field of, data science and machine learning, particularly in context of finance, right? And of course, if you don't want to do the entire course, if you have specific requirements, you can do a sub part of the courses as well. You can only join the data science for finance part. Then that's like a 3-month module which you can do. If you want to learn only the machine learning for finance modules, you can do that. I mean, that's like a 4-month module. And then what we have is like, again, this is something which probably would be very interesting for a lot of you. There are super specialization modules teaching like, again, specific areas of data science and machine learning applications in finance. So basically, as a part of the AI for Finance course, we give you a choice of 4 electives at the final part of your course. So you can choose to do any of this or any one elective out of this 4, right? So there are specialization modules on AI for generative, AI for trading, AI for risk management, AI for derivative valuations, and there's a module on generative AI for finance. So you can select any one of this specialization area as your final elective module. Of course, again, later on, if you wish, you can do multiple of the specializations as well. But as a part of the course, you are given a choice of any one elective. But these are all, this particular course is very modular, the entire AI for Finance course. So essentially, like again, you can later on do only any of this other specialization modules as well, apart from the module that you have selected, right? And if somebody already have a good background in data science and machine learning, they can directly go and join the specialization modules, right? So then you don't need to do the entire course, right? So yeah, these are some of the courses which one can look at, along with your job, or if you're studying along with your educational degree, you can do, and then these are all job-oriented programs, right? So yeah, I mean, over the last 15 years, we have been fortunate to have like thousands of students and professionals who have done our courses, and I mean, who have utilized our courses to definitely make a great impact in their careers. I mean, meeting which have made their dreams of actually either joining a quant team or like maybe going deeper into the quant profiles or related areas, right? So, I mean, some of this are like again shared in our website, their experiences through written testimonials or videos and all that as well. It is not like to basically like again maybe advertise our courses, but again just for you to understand, right, that how you can actually like utilize these courses to build your career as well, right? So I mean, say for example, Madhusudan, I mean, he was already a very senior professional, but he did a CPAIF program, and then I mean, utilized this to clear the quant interviews, and now is working in credit risk modeling. Similarly, Abhijit, I mean, also already was working in risk, but then he wanted to understand the more deeper quantitative modeling. He did the QFRM course and went deeper into the quant risk modeling areas, right? So somebody like Rohan, he also like did the CPFE, and then again was already an FRM before doing a CPFE, but through to understand the quant field in more deeper level with the modeling and all this kind of practical inputs. So essentially, he was able to break through into a quant team, right? So now Yatish, he was a fresh engineering grad, did our PGPAT course, learned very well. We were fortunately able to place him as well. I mean, in one of the quant trading desks, and then that was the start he needed. Now he is doing very well actually. Like he is managing, in fact, like a huge amount of corpus independently as well. So essentially, like again, these are some of the people. I mean, you would get a lot of this kind of information in our website. This is to showcase how you can also utilize, right? And in terms of as I was mentioning, these are all job-oriented programs. So I mean, you all can utilize this to actually I mean, enter into this field, or if you're already in the field, I mean, we go to go deeper into the field. So, I mean, our support system starts not only during the course, even before when you actually come in contact with us, right? So, even before you select the course, we counsel you on the right course, and then once the course starts, all the courses are taught by leading experts from the industry, right? So you have a thorough career mentorship from like them as well. I mean, during the course, post course, there's a dedicated placement support team who guides you through the entire journey: resume building, interview preparation, your LinkedIn profiling, and then helping you in like again getting you the right interview calls. I mean, you utilize our strong industry network association, right? So essentially, like we do help you in like in a very comprehensive manner. It's not about just doing the course. It's like again, we try to help you in the entire career building process, right? So these are some of the companies. I mean, just like a small example of the kind of companies which you can apply for. Of course, I mean, hedge funds, investment banks, international banks, stock exchanges, big four consulting firms, IT companies. So these are all would be like your area of target, right? I mean, there's a huge requirement for, I mean, this kind of quant profiles, and particularly India. I mean, of course, abroad there's a lot of requirement, but India also is considered the global hub of this capacity building initiatives, right? GCC, what they call, right? So it's like in India that like this is increasing, and I recently read a report that again. I mean, the GCCs for all international banks, I mean, they are trying to actually increase the footprint, and maybe like again, a million or more jobs will be created in the next few years only, right? So this is like a huge opportunity for anybody to actually make a career in this kind of field, right? Yeah, these are some of the roles that you can target. This is a very small indicative list. There are a lot of more we can do, right? Yeah, and then I mean, of course, we have been working, as I said, for the almost more than 15 years now. So I mean, virtually everybody who works in the quant and risk management field or like the machine learning AI related field, we have been working with them, particularly in finance, right? So I mean, this is a very small indicative list. Once again, yes, and in our endeavor to promote the field, we try to, I mean, promote these fields among students as well. So we do uh, conduct our I mean different events and organize a lot of things in the leading educational bodies as well. I mean, IITs and other bodies. So yes, anybody who is interested in like again understanding more about us, our courses, or like discuss anything. I mean, even apart from the courses, you want to discuss anything, right? So essentially, these are our contact information, the website, email, phone number. So please feel free to reach out. All right. So I mean, as I mentioned, right? So essentially, like again, we would be happy to actually take up a question. So like let's go to the questions now. So Sanjay, if you are ready, we will take up the questions. And for others also, like again, if you have any other questions, queries that actually you want to discuss, please feel free to type in your questions. I will be happy to take up. Right. So first question, Sanjay, is from Sanjay Veer, and he has asked. It's like I would like to understand how traditional finance is marrying quant finance in the aspect of equity or derivative valuation.
Okay. Yep. Sanjay, so that's a very valid question, and thanks for asking. So basically, the traditional finance, as well as the area of traditional modeling, has been more focused on building siloed models, which are basically either for one use case or for one application, like front office or risk management or hedging, or maybe the financial valuation, balance sheet valuation. But in the new area, right, maybe the AI and ML adoption has brought a immense capability, which is maybe covering all these as a pipeline solution, right? So as part of the unified framework, the pricing framework, a single capability is created which could be leveraged by different downstream application and use cases, and the data processing capability has increased, the computational power has reduced, the efficient use of computational power has increased, the computational resources are now less utilized for running the model. It has given birth to real-time analytics, and real-time pricing solutions and hedging solutions and pricing optimization solutions. And many of the firms, and along with the case where I told you that alternative data set, harnessing the power of alternative data set for building sentiment indicators in your models, or for trying to embed the climate and sustainability risk in your models. So all this put together, right, as well as the challenges which were already there inherent, and the uh, further maybe advancement was impeded by those challenges, which are now easily, one could overcome those challenges using machine learning AI models. uh, we could say that it's not just a disruption, it's a transformation. And tomorrow's quantitative financial discipline would be purely data driven based on AI and ML techniques. Yeah, and
Yeah.
one aspect, maybe, sorry, I missed on equity. You specifically ask about equity markets with respect to stock price forecasting and equity index forecasting, or maybe the not only the price but the volatility of stock prices and the volatility of equity indices, right? In that area, I suppose that is the bedrock, and a lot of groundwork has already been done. A lot of models have already been built. They are getting trained, rather to find new patterns, as well as to, in a more nuanced way, to understand the market at a micro level, rather than building the models for a macro market, rather than the understanding the market at a micro structure level, right? What are the index specific nuances? What are the stock, especially the large cap, within the large cap, if you could segment these stocks by different maybe sectors, industries, regions, and their cyclicality to the market, or their vulnerability to the market, their leverage effect, their liquidity effect. So a lot of these things are being explored. Now the focus is for next few years how to do equity pricing for private equity, right? Or for even for illiquid stocks, even for some of the small newly listed small and medium enterprises, right? And you see the startup culture that maybe new firms are getting listed, but they don't have a trading history or trading prices, how to do the solve the pricing problem where you don't have a trading history, right? So that is also being very much explored, and in few years that would also be exploited. Once that would be exploited, right, it would be rubber stamped that the whole paradigm shift towards machine learning and AI is quite inevitable. Yeah.
Correct. Absolutely. So I hope that answers your question, Sanjay. And of course, if you have a follow-up questions, please uh, feel free to add anything you want to add on that. So we'll be happy to take up. But in the meantime, going to the next question. Next question is from Fabian, and he asked. So he works with the JPMC data product team. So he says that I would like to know what data strategies we need to focus on AI ML efficiency gains.
Hmm. Okay.
That's the
uh,
question.
Yeah, so thanks, Fabian. And there are two parts of to the data, right? How to maybe address the data problems, or maybe live up to the data which we need to train the models specifically for AI and ML. Now, AI and ML models are generally very data hungry models as compared to the traditional models. It means that the kind of data you require to train the traditional models, the requirement from AI and ML would be quite massive, quite maybe the size of the data, or the volume of the data, or the maybe dimensionality of the data is going to increase too high, because and that is quite obvious. If you simply see, you are trying to understand some pricing relationship patterns which were not very clear by while using the traditional models. And the AI and ML would want more data to learn and to uncover those particular patterns, and based on those particular patterns then to forecast the prices which are more aligned with market, which are more better calibrated with the real market data, right? So there are two parts to the data. One is that how to uh, as a data scientist, how to do more data mining, right, including traditional data and alternative data set to bring more data in your pipelines, machine learning pipelines, right? So that is nowadays in a mature organization is a job which is trusted with a experience or trained data scientists who perform that particular job. They work on different data sets, right? Some of those data sets are never looked before, some of them are never considered before, some of them are considered to be too noisy, right? And some alternative data set were completely ignored. So look at because data is the gold for the future, right? So one thing is for data scientists to keep working on different data set and doing their analytics, doing their data insights and data storytelling and data visualization, and then building a use case that okay, this data set could also be used for this problem set, to further enhance the model accuracy and precision, right? So that's one aspect to it. The second aspect to it is that within the model, a machine learning researcher or a machine learning subject matter expert would be required to not only consider these new data set, but also to identify new patterns and do some attribution, right? Because these are not theory based models. Machine learning way or AI way of doing modeling is a data driven way of doing modeling, right? Now when you are using some data, you could have two possibilities. Either the data could tell you some spurious relationship which would lead to distortion of facts, right? And there's a fake truth as well, that some of these data is created by generative AI, right? A machine learning expert need to consider a lot of other regulatory aspects as well: data privacy, data confidentiality, maybe data sensitivity, right? The data, whether the data is verifiable, right? All these aspects, whether the relationship which has been pattern which has been discovered on this basis, this new data is not spurious, it holds some statistical relationship, right? A significant statistical relationship what to be considered in the model. So all these kind of things need to be considered by machine learning expert, based on what kind of machine learning model they are trying to design, right? Because it would be then based on different neural networks or different architectures or different modeling techniques, uh, AI ML techniques which they are using to design the model, right? They need to explain with a lot of focus on model explainability, as well as data traceability, right? How to make the input data traceable to the output. Yeah.
Yeah, absolutely. So I hope that answers your question, Fabian. And maybe if you have a follow-up question on that, please feel free to let us know. All right. So in the meantime, moving on to the next question, which is from Anukul. And Anukul works in the Wells Fargo team as like a AVP Quants. And so he works in the, is from IIT Kharagpur actually. So okay. So his question is, how can we incorporate text analysis using LLMs for, okay. So you have mentioned, Anukul, rising of path-dependent derivatives. I am assuming that you are talking about pricing of path-dependent derivatives. Correct me if I am wrong. So the question is, I have questions about how can we incorporate text analysis using LLMs for pricing of path-dependent derivatives. Did I interpret the question properly, Anukul? I mean, if I have not, then please, yeah, pricing. Okay. Yeah, so that's the question, Sanjay.
Okay, so Anukul, first of all, thanks, and your question is very profoundly intellectual, and maybe it's a puzzling question for any quants and modeler, right? And there's no definitive answer. So bear with that, right? The only thing which I could think of is that the LLM models provide you the capability of doing text mining, and you could use all the sentiment data out there, the analyst prediction, their comments, commentary around their forward guidance on companies' earnings and their stock price paths and all of that, right? If you could use that particular data to build sentiment indicators, those sentiment indicators could be used in the scenario generation, like while performing a new paths based on those particular sentiment indicators. Like if analyst is predicting that the future is pessimistic and bearish, the market and extremely bearish, or there's a mild bearishness, right, where the cycle is turning, right, that could be used to calibrate the shock factors in your model, right? If based on sentiment, thriving sentiment, prevailing sentiment, the market cycle is turning and the people are turning pessimistic, bearish, or mild bearish, you could then apply different shocks of different size. You could calibrate your shock sizing based on the sentiments in the market. That is one area which I could possibly think of, that it would be a value add, right? Because the generally we do stress testing and maybe scenario analysis, but generally the shock sizes are never calibrated to what the market think, and what are the opinions expressed in the market, what is the thriving sentiment in the market, right? What is the market outlook from various pundits and observers in the market who are well known, right? So based on that, maybe we could do the shocking of the stress factors within a stress scenario. Yeah.
Yeah, absolutely. Right. So Anukul, does that answer your question, or like again, do you have any follow up on that? Wonderful. Great. Okay. Thanks, Anukul. Okay. So moving to the last question for the day, because other questions actually are like almost repetitive. So this will, I mean, I'm combining questions from two person, or maybe like let's take one by one, right? So both are career related thing, right? So one is from Dhananjay, and he says that he is a recent engineer. He has passed out like again in 2024. He has joined an IT company, and he wants to make a career as a quant. So I mean, how he should go about it?
Uh, so Dhananjay, first of all, maybe my best of luck. And since you have started a new career, right, and that too, maybe it's a good beginning, right? And you also, in the nascent stages of your career, if you want to maybe quickly transform into some real niche sectors and niche jobs which are highly paying, but not just highly paying, it's but present you a lot of opportunities in career to settle abroad, to maybe work for very well known renowned companies, the top notch firms on the big street firms, big street banks, right? You have to require some kind of a pre-planning, and the earlier you pre-plan, obviously the better you would be placed, because some skills have their own journey, and these are not simply some leadership kind of a skill or some soft skills, but these are very hardcore skills which have its own journey of 2 3 years for you to get there and claim that you are the stuff, right? And the earlier you do it, the better, right? The other part is that since you are an engineer and you have freshly graduated, so some of these engineering concepts, specifically the mathematics, the partial differential equations or whatever you learned in, right, during, or maybe some of the Fourier series, or some of these things would be still fresh. Taylor expansion, some of these things would be still fresh and relatable to you. The more you would be withdrawn from your academics, and you would see years goes by, and now you are a working professional, you would lose touch and then you would have to put that extra effort to go back and visit your textbooks, and maybe some of these things would not come naturally. So you have an added advantage of starting early, and the earlier you start, and the better it would be for your journey. And the other part is that for those who are in nascent stages of their career, by what I mean is less than 5 years of experience, the opportunities are great, right? There are so many opportunities. People are generally judged at a higher level when they achieve around 7 to 12 years of experience, right? And then after 12 years you are judged for your leadership skills or your transformation skills, whether you could be a head of quants or head of machine learning umbrella, or some kind of capability. But between 7 to 12 years, right, you could be judged differently, right? But below 5 years or below 7 years, there are massive opportunities where people don't judge you too much. They judge you for your machine learning understanding, or for your modeling understanding. But even if you are moderate in domain, right, suppose you are moderate in your moderate understanding of derivative pricing, or maybe or any other thing, algorithmic trading or risk management, would make you easily sellable, or maybe easily attain a good job in a good bank or in a good firm, right? Because generally the recruiters also understand that domain experience come with the few years spending into the domain, right? So that's maybe all of that, summing that up. The point is this, that the nascent stages are the best time to move in a numerate or quant field, and the likelihood of switching careers, or changing your direction of career is quite high, right? Because the demands of the recruiters are not that high, right? As well as maybe at that level, if you acquire skills, you would then maybe start looking at jobs which are any which way available, right, at a low level, at a starting level. across different firms for different projects, right? So you could maybe, so it has its own advantages. So I think all in all, you should try to leverage that particular advantage. It's rather an advantage than a disadvantage of being an early career and early starter, right?
Yeah, absolutely. Absolutely. So, yeah, I mean, just to maybe add a little bit. So, I mean, very well summarized, I mean, Sanjay. So, I mean, mostly again, that probably has already covered your, I mean, how you should start. So, maybe like again, in current context, uh, the knowledge industry actually like has progressed hugely, right? I mean, both like again, there are different resources that have been utilized to catch up on any domain, right? And since you are just starting out, you can tailor your career to any direction you want. I mean, if you are looking to enter into the quant domain, of course, like again, build your mathematical background as much as possible. I mean, if possible, go and learn the domain as well, right? So these are things which will additionally help. And as I said, most of the things of Sanjay has mentioned. But yeah, just like very quickly, I mean, I mean, to quickly get up to speed, you can actually do the quant courses as well if you want to, right? And that helps you in like quickly making your background and like making a quick move, right? Okay. Uh, so that I hope that answers your question. Any follow-up, please feel free to let us know. And I mean, for you, if you need any guidance, you can call us directly on a number. I'll be happy to actually guide you on how to go about things. All right. So next question is from Grosio, and okay. So let me first try to decipher the question as such, right? So he is mentioning. Hi, these are addressing theory or only in practice. For example, AI, ML, DNN is provided the mathematics of this, the algorithm, or only the final results of the valuation. So I'm assuming that you are talking about like the courses that we do, Graju. Right. So maybe like again, since Sanjay is also one of the leading faculty as well, particularly for the data science machine learning course. So the question from Grozio is that I'll just repeat is mentioned that again in the courses, are we teaching theory or only in practice? Or for example, AI and ML DNN is provided the mathematics of this algorithm or the final results of the valuation. So what is trying to understand is like again, what is our pedagogy, to be very honest. I mean, whether we are teaching only theory or like we are teaching the practical modeling of that as well. So maybe like again, as I said, since you are one of the lead faculty, so I'll let you answer that question.
Okay, maybe thanks for asking, and that's also where we, at IIQF try to differentiate ourselves as much as possible, right? That
Right.
obviously theory is the bedrock, right? And theory doesn't mean that we would be teaching you maybe the maybe some textual kind of thing, right? Or maybe something which is just purely theory, but it would be rather mathematical results of some of the useful functions, as well as while teaching that, one of the demonstration of that would be doing that in Python, right? So if I'm talking about, like, for example, wherever we are teaching Monte Carlo simulation, or maybe any algorithm like a deep neural network, right? And we are talking about a function, uh, it it would not go without, I don't know uh, what you are referring to, but maybe it could not go without teaching that particular thing in Python, like the step by step coding, as well as how, on a particular data set, financial use case or data set, you could go from scratch and try to implement whatever you have learned in that particular mathematical axiom, or auxiliary results, or maybe empirical proofs, right? right? Because that is the proof to the pudding, right? And maybe if that is not taught, maybe no matter whichever course is, that is not doing justice, and then it would not make you industry ready. And we our focus is to make you industry ready, as well as we also keep updating our course from time to time to cover a lot of topics. Like when we started maybe a few years back, at that particular point in time, for example, explainable AI was only in research academic circles, right? But we still made that an effort to try to include a separate module, because we thought that maybe uh, if somebody could be initiated in understanding what could be different statistics or different techniques or different way of explaining the output of a AI/ML model, right? Then they would have a differentiated advantage as a candidate, right? And obviously it's a research area, it's a industry focus area for adoption. But somebody who is already knowing it, that particular thing, would be seen differently from rest all, right? So a lot of these particular topics are maybe brainstormed by a internal panel of experts. We rope in some industry best of the industry experts as well. We have panel discussion, right, to include those topics, case studies, and somehow maybe new industry practices which we could embed as much as possible to make our to give a practitioner view on AIML adoption rather than just being theory, right? So our starting point would always be uh, making you deep rooted in theory as much as possible. And by theory I mean mathematically rigorous understanding of the techniques and the recipes and the ingredients of those or components of those models, and then eventually also parallelly showcasing each of them, how you could have implemented those or played around with those, right, in Python or any analytical language for that particular matter. Yeah. Yeah,
Yeah,
Nitish,
absolutely. And
you would like to add something?
so, oh, no, no, no. I mean, I think you have covered pretty much actually. So, Grozio, I hope that answers majority of your questions. So, and in terms of, I mean, your materials that actually we provide in the course, it's like again, so all the supporting materials that are required are actually provided in the your LMS. I mean, every course every student has the access to the LMS, and for each course that you subscribe to, I mean, you would have access to that particular part of the LMS, and I mean, all the course related notes, presentations, the related research papers, the Python models, Excel models, whatever is the supporting material, these are all provided access to you through the LMS. And I mean, these are of course provided in the soft format. I mean, we don't provide you any hard copy of material, essentially, like. But yeah, I mean, there are a lot of supporting materials that we provide, right? So does that answer your question? All right, wonderful. Thank you. Okay, so the final question is similar to the question that we took up, but again, a little bit more specific. So maybe like again, let's take this question and then we will wrap up the session for the day. We are already 15 minutes past time. So this is from Ayush. Again, he has also done his engineering, but he has done in 2022. So he is working in about 3 years in again in an IT field, but he wants to move into particularly in areas related to data science, machine learning applications in finance. So again, he wants our suggestion on how to go about it.
So I think it was from Ayush, right?
Yeah, yeah, that's correct.
Yeah. So Ayush, that's maybe rightly said that maybe that's the direction of travel, right? And it's no surprise that you are rightly making that you know choice, or at least started thinking in the right direction, right? From a transition perspective, for those who are hardcore from computer science or engineering background or working in IT roles, one particular inherent advantage of those people is that you are anyway you know reasonably good, assumed to be reasonably good in coding, right? If not, but that's not a prerequisite for any of our courses. We would teach you from beginner level to intermediate to advanced level coding in any of the programming languages which we would be working on, as well as some additional uh, visualization tools like Power BI, or maybe we would be providing that support. uh, but the point is this, that you still have some kind of a skill which is very much required for data science, machine learning and AI. The other part where you need to have a journey, and that's quite a charted journey for you, is uh, understanding the statistics and probability and mathematics, right? Where we provide a lot of very exhaustive and extensive primer modules for somebody who either have no background in the on the topics, or generally even if they have read it somewhere, but they have never seen them the practical application of those topics, right? Like for example, if somebody has already seen what a hypothesis testing mean, or how what confidence interval means, or what different discrete or continuous distribution means, they might be knowing it theoretically, but we would provide them our primer would cover the practical application of those, right? If you cover those particular basic primers, which are not basic in a sense, maybe they are the starting point, that's why I'm saying they are fundamental to the main modules. Half a battle is won if you cover them. The kind of depth we provide there, half a battle is won, right? And then our mainstream module focus on parallelization of the techniques, methods, right? Approaches, different data science, machine learning, AI techniques, approaches, methods, as well as implementation that will go in parallel. Like we choose to get it done in Python because Python is the de facto language, and it's the mostly the demand on most of the job description. So we and that's why maybe one of our starting primer is also exclusively built for training people in Python, right? And then we will take you through those particular use cases. So I think maybe if you are seriously thinking about maybe getting a future career planned in data science, machine learning, AI, uh, I think you should be starting early as possible, and that's for everyone, right? uh, because the industry is changing, and once the industry will mature, then the requirements of the industry would also be, because currently there's a demand supply gap, frankly, right? The demand is huge. The supply of such resources, trained resources in data science, machine learning, AI, is not that great. Or even if people have done some light touch courses, they are not up to mark as per the industry standards. So the point is this, that in next 5 years, if the industry will mature, even if somebody is skilled, the requirement for them to be hired, or maybe the evaluation criteria could be pretty mature, and still the industry is in open state of mind that they are hiring people who understand these topic well, right? But they are not just trying to force you to do some kind of hackathon. And the future in 5 years, what I meant why the industry will mature, I see from industry perspective that there would not be in any interview, there would be hackathons, right? And people will be asked to solve a real time problem, create a code, and put it in their repository, and based on their repository submission of the code on the repository and their implementation, they will be evaluated. The candidates would be relatively ranked. That would be the direction of future hiring, right? But as on date, that is still 5 years ahead of us. But the point is this, that you could, the earlier you could start, the earlier you could make a beginning in the career, right? And the earlier your skill set would also mature to that level where if anyone could ask you, give you arbitrary data set or arbitrary problem, you could do solutionizing and build the do some implementation of the code all by yourself, right, from scratch up, and using some ML pipelines, right? That kind of skill, if you can attain in next 5 years, then the sky is the limit for anyone. Yeah.
Yeah, yeah, absolutely, absolutely. So very well summarized. I mean, please feel free to ask any further questions you have on that. But yeah, I mean, Sanjay, I mean, very nicely covered. Thanks for that. All right. So Grozio has a follow-up question. So maybe like quickly, we will take this and then we'll wrap up the session. But just to conclude his discussion, so Grozio mentions that actually, for example, we use Murex trading systems. Now they are implementing deep learning to value exotic derivatives. In the course, I like to understand the mathematical understanding of the process of valuation. Could I have uh, just a minute. Could I have this kind of detail in this program? So let me start, and then Sanjay, maybe you can add on that, right? So Rajya, that is exactly the intent of the program, right? So I mean, before going into the teaching the practical modeling and all those kind of valuation of pricing, derivatives, different asset classes, risk management, and all that. Before that, we first strongly believe that like the background in mathematics is very important here, right? So if you see the course structure, particularly in context of this discussion, I would request you to look at a course we conduct called Certificate Program in Financial Engineering, right? So that's a course which builds the mathematical foundation very rigorously, right? In terms of covering the relevant areas of algebra, calculus, stochastic calculus, your advanced probability theories and probability distribution theories, numerical methods. So first building the background, and then after that teaching you how to apply the mathematics and method for modeling the models for different derivative assets, be it equity derivatives or interest rate derivatives or your credit derivatives, currency derivatives, your swaps valuation. So for each of these assets, we go into understanding the models in deep and then implementing the models in Python, as Sanjay was mentioning. I mean, in every course, I mean, the final conclusion is to teach the modeling as well. But before we go into the modeling and understanding the models, we first build your mathematical background, right? So yeah, that is pretty much an agenda as a part of the course. Okay, so do you recommend some references or literature specialized related to the program? Yes, of course. I mean, we do recommend some additional books as well, so which can be good for your library. Maybe you can for reference during your course, and most importantly, post the courses to when you want to go and dig more deeper, right? So that's like I think from my side of graduate. I mean, I'll be happy to connect with you personally and like I mean discuss all this in more detail if you wish to, right? I mean, let me know, and then I mean maybe I mean I can call you also, and like or maybe you can call me and we can have a like a discussion around this. But Sanjay, anything you'd like to add on that?
Yeah, just a few more things. First of all, with respect to the depth which we would be covering in our courses, it's unparalleled, right? I would rather say that we are not just boosting about it, but rather it's other way around. Sometimes, the many of the candidates who join in with the expectation that it's a easy saleable course as other courses in industry, right? To their surprise, right, they sometimes say that why we are covering this depth, right? Is it required, right? And we also try to career guide them, career coach them, that okay, if you want to become a full-time quants, this is what is exactly required, right? This is, so we are not going to teach anything half baked way, right? We have a full baking thing. And the kind of maybe reference material what Nitish said was, obviously every module, whatever topics are covered, there's a list of reference books, which are some of those are provided in the soft copy as well, while others are also uh, given to you as a reference, that if you could buy those books and read through those books, that would provide a strong foothold for you to cement your understanding of the topics. So there would be definitely a reference material, but our slides and our material in itself is so curated that sometimes even in the initial spell during the course journey, even if you would be able to absorb and cover that fully, reasonably you would be prepared, very well prepared for the market. The other part is, obviously, if you want to be a researcher, if you want to be someone who could be seen equivalent to a full-time financial engineer or a full-time quants degree programmer, quants degree professional, right, then definitely you would need to further maybe do deep dive, and we would be helping you there as well. Yeah.
Right. Yeah, absolutely. Thanks so much for adding that, Sanjay. So yeah, Crozius, I think that like answers your questions. And as I said, we would be, in case you think you wish to, then we can actually discuss in more detail in all of these aspects, and maybe we'll be happy to guide you. So let us know. And so with that, actually, like again, I mean, we have come to the end of the session. So first of all, thanks to the wonderful audience. You have been very patiently attending the session. And again, it's great to have so many very pertinent questions. There are some more questions which I'm not taking up. Because like those are like more of like a repetitive nature. So I believe most of you have got the answers to the questions that actually you have put up. So I've tried to curate the questions and like again cover all of them. If anything we have missed, I mean our numbers are given to you, so please feel free to connect, and we anyway would like we can have a one-on-one chat as well, right? Okay, sure, Grosio. We would you are in Mexico. It's like 2 a.m. I understand. All right, so I mean we would communicate at a more I mean right timeline actually, right? So that at a more better time. So nonetheless, right? So I mean, we will connect with you according to maybe a convenient time according to your suitability, right? So yeah, with that again we come to the end of the session. So yeah, and after the audience, I mean, thanks so much, Sanjay, once again for your time. I mean, you are really lovely. I mean, we got a lot of insight as always, and thanks for answering all the questions as well. Thank you so much.
And thanks for all the audience for their active participation and questions, which also keep us knowing more about maybe what is the pulse of the market. And obviously there's a two-way process, and we could also get some feedback, right, how we could make our course design more effective to cater to your aspirations. And in that endeavor, your questions would always be helpful, and thanks for that. Yeah.
Absolutely, absolutely. So, I mean, as I've already mentioned, and most of you who have been uh, part of like our webinar series earlier, as you all know, but those who are new, just to mention, I mean, we conduct regular webinars as a part of our series on deep dives with IIQF experts webinar series, right? So every month we conduct 1 or 2 webinar, and we might increase the frequency as well. But again, keep track of our various social media pages, our website, and anyway we do communicate over email and WhatsApp and all those kind of other modes as well. All the later announcements you will be keeping you will be kept posted, and you can also keep yourself abreast with the developments in our social media pages and the websites and all. So please follow us, and I mean join us in the next webinars as well. Look forward to see you again, right? Thank you. With that, we'll conclude the session for the day. Thanks again, once again. Thanks once again, everyone.
Thanks.